What's up, guys? So this session is going to be focused on picking options contracts. So we're just going to dive right into it. So obviously you have the stock that you're trading and we trade options contracts. This is going to be more of a beginner's course for new people that are joining so people can understand how to pick options contracts. So I'm on my Thinkorswim platform here, and basically we're just going into picking an options contract and the basics of it. So we go to trade. Basically, we're looking at all these different expirations. So each of these contracts, this is the date of the expiration for each of these contracts. So if we go here and we click and we're looking at different options contracts, we have the calls on this side, puts on this side. These are the strike prices, and this is the expiration date. And so the strike price is basically where you're going to be. So what you're buying in these scenarios, or when you're buying an option contract, basically you're buying the rights to shares. This strike price decides what share price you're buying them at. So the ones that are further out of the money, they're more likely not to be worth anything by the time it gets to expiration. So that's why they are cheaper. And then as you go in, they have more intrinsic value. But that's getting into it a little too deep. So we're just keeping surface level. So the things you want to look at is the strike price. So you can pick this based on whole numbers. I think of numbers like based on five. So like 150, 155, 160, 165, 140, 135, and so on and so forth. Just by fives. That's how I like to do it. Preferably pick based on whole numbers, kind of like 150, 160, 170, numbers like those, where they're bigger psychological numbers, because these contracts are based on supply and demand. So you want to pick something that's more than likely going to increase in demand. The 160 call is probably going to increase in demand more than the 157.5 call. Reason being is because a lot of people pick contracts based on profit targets, especially when they're swing trading. So they'll pick the 160 because that's a big psychological number, and that's just the contracts that people like to gravitate towards. So you want to buy those because naturally they will increase in demand as it gets closer to your price target as well. And they will just tend to move a little bit better and get a little more of a premium spike when people become interested in the stock, and especially when it goes in the money. So like if this 160 goes into this blue area, that means it's in the money and there's real intrinsic value. All these ones down here, the black and the black here, those don't have any real value because the stock price for calls is below 150, and for puts it's above 149. So these are out of the money. These aren't worth anything. So when the stock price gets to 140, this put will be worth 100, or will be considered in the money when this gets to 139.99, the stock price. So that would create it to be in the money. Because it is at $149.70, the 150 call, it's not above 150. So the 150 call is considered to be out of the money. So going back to picking options contracts, you want to pick something that has a nice round number that you like. I say by fives, preferably. And then we go into next price, obviously. Pick something that's good size for your account. I say if you're swaying at 5%, 5 to 8% at most. But besides that, you can really, the option is based on your account size. You don't want to buy really far out of the money here because they decrease in value quicker. So do these ones here. And then so that first thing we want to look at is we want to make sure it has a decent amount of open interest. My preferred number is over 1,000 open interest on contracts. That means there are 1,000 people currently have open positions on this contract. So like, for example, here, this has almost 61,000 open people that have open positions in this 150 call. And you can see the ones that have these nice round numbers, they typically have bigger open interest, meaning more people opening these positions. So The 155 you can see is much higher than the 152.5. This is 12,000 versus 44,000 and 60,000 for the 150. If we go look at the 160 call, we have 40,000 opening, right? We go look, you can see just if you just look through these, the open interest is much higher on these nice numbers by 5. So the first thing is we want to have open interest over this. We want to pick a nice round number. We will measured by 5s. I pick an open interest of over 1,000. Volume is more important when you're day trading. I would say when you're day trading, you want something with over 1,000 in volume, but swing trading doesn't matter as much. Delta, this is how much money you're going to be making per dollar the stock moves. So if Apple moves up $1, this contract will go up about $48 per contract. So right now it's at 250. It'd probably go to about 3 every time it moves. But one thing you want to keep in mind is as these get closer, as the stock gets closer to the strike price that your contract is at, this number will increase. As it gets further away and so-called out of the money, this delta will decrease. So the idea is you want it to move closer to in the money or just be in the money to receive the best return per contract. You can see as you go up, it increases up to 96 here, right? 99 all the way up to 99. Continues to decrease all the way to $1 per dollar move in the stock. Makes sense? Okay, so we've gone through each of these. Pick a nice number for the strike price. You want to have an open interest of over 1,000. Volume, if you're day trading, you want over 1,000. Delta, you want to try to get the highest delta as possible because then that just means you're going to make more money per contract, right? And implied volatility, this basically means like how much premium is priced into these contracts. So the contracts are made up of intrinsic value, which means like real value. That's all these ones in here. And then there's extrinsic value. So like basically time, or you're basically buying time on these to see where it moves. So that would be all these contracts here are just straight premium. So when it gets to options expiration, which is this week, if Apple closes at 149.70 and stays the exact same, just say for the sake of this scenario, all of these contracts here will be worthless and worth nothing by the time of Friday. These will all have some value in them because they're in the money. Out of the money, these will all be worthless. So for implied volatility, this is basically this premium here, how much premium built in all of these contracts as a whole. So 38% is a pretty decent amount. I would say the best thing to do is lower implied volatility, the better when it comes to picking an options contract. So I kind of stay away from stocks that have, or options contracts that have over 100% implied volatility. So these are at 38%, but if you go look at like AFRM, these are at 120%. So at any point, this IV could crush and go down to back to like 30% or whatever. And that will make these contracts value decrease significantly. So just keep that in mind. The higher this is, the higher chance of a fast decline in value on these contracts, especially when it's getting close to expiration. Let's go back to Apple. So recap, just some basic guidelines I like to follow. You want to pick a nice number like by 5s, 150, 155, 160, and you want it to have good open interest over 1,000. You want to have it close to being in the money here. If you're day trading, you want to see over 1,000 volume. And then as for the delta, you want the best delta as possible. The higher, the better. I would say at the money contracts are the easiest to go to, or pick your profit target. It just needs to fill these requirements. So like if you think Apple's going to 160, buy the 160 call, implied volatility, you want to see this over or under 100%. really to be safe under 80%. So one more recap, we go to strike price. We want to pick a nice round number, right? 150, 155, 165, things like that. And then open interest over 1,000, volume when you're day trading over 1,000, delta you want the best as possible, and implied volatility you want under 100%. So that really wraps up what I'm wanting to show you guys, just the basics of picking an options contract. And yeah, so thank you for joining or watching. Hope this helps.